Hey everyone, welcome back to the deep dive. So this time we're digging into a chapter you guys sent over from Mandate for Leadership, and it's all about the Federal Reserve.
The Fed.
Yeah, exactly.
Mm.
You know, the people who basically control our money.
Well, they try to.
Well, yeah, that's what we're going to talk
Yeah.
about. We're going to break down its history,
Mhm.
all the problems, and then some potential solutions. So no economics degree required.
What I find so interesting about this chapter is that most critiques of the Fed, they just kind of complain. But this one really digs into some specific reforms, actionable things that they think could actually make a difference, which is really rare to
Yeah.
see that level of detail.
Yeah, and right off the bat, the author makes it clear that money matters.
Yeah.
Like, really matters. It's the backbone of a healthy economy.
Oh, absolutely.
I mean, think about it. If prices go crazy, even just your daily latte becomes a budget buster.
Right, like everything's affected
Everything, yeah.
if the money's messed up. And that's where the government comes in. They set the rules of the game for money through what's called monetary policy,
All right.
which is where the Federal Reserve, the Fed, enters the picture.
So the Fed was created back in 1913 to try to prevent those, like, crazy financial crashes that used to happen.
Yeah, they wanted stability.
Yeah, like all the time.
Right.
But here's the catch.
The U.S. has continued to have these, economic downturns pretty regularly, almost every 5 years since the Fed was created.
Really?
It's kind of wild if you think about it.
Like clockwork.
Yeah.
Wow. And then there's the big one, the Great Depression. And the chapter points out that the Fed's mishandling of the money supply was at least partly to blame for that whole mess.
Yeah, that was a big one. And what I find so fascinating is how they connect these recurring downturns. Two main things. One is the inherent difficulty of trying to control the money supply. And then two, all the political pressure that the Fed is always under.
Oh, yeah.
It's like trying to walk a tightrope during an earthquake.
Right. Yeah, exactly. Okay. So trying to keep things stable is hard enough as it is. But then the Fed is also supposed to juggle two huge GTE responsibilities. The dual mandate, as they call it.
The dual mandate. So the Fed is supposed to aim for both stable prices, basically keeping inflation under control so your money doesn't lose its value.
Right.
And maximum employment. So they're going to keep prices steady and make sure everyone has a job.
Oh, wow.
Two goals that sometimes pull in opposite directions.
Oh, for sure. It's no wonder they struggle.
Yeah.
And the chapter actually argues that this dual mandate might be part of the problem, that it contributes to those very recessions they're supposed to prevent.
Yeah, it's a really interesting argument, and it raises a question. What if they just focused on a stable dollar? Would that actually lead to a healthier economy overall?
Yeah, food for thought.
Huh.
And then there's the whole lender of last resort thing. Sounds kind of heroic, but the chapter suggests it can be a double-edged sword.
Right. So the idea is that the Fed steps in with emergency loans to banks when things get really bad, prevents a total meltdown. Like in 2008, they pumped trillions of dollars into the system.
Right, so they were like the financial superheroes swooping in to save the day. But this chapter argues that by always being there to bail them out, it encourages them to take bigger risks.
Exactly. Like if you knew your car insurance would cover any accident, no matter how recklessly you drove, might make you a little less careful.
Yeah.
Economists call that moral hazard.
That makes sense. And this leads us to the next big issue the chapter tackles.
Yeah.
Balance sheet bloat.
Ah, yes. This is where it gets really interesting. So imagine the Fed's balance sheet is like their bank account. After the 2008 crisis, it ballooned to over $8 trillion.
Whoa.
To put that in perspective, that's like giving every single person in the U.S. a check for $25,000.
Wow, that's a lot of money.
Hmm.
So what are they holding in this giant account?
Mostly U.S. Treasury debt and mortgage-backed securities, which are basically bundles of home loans. And the chapter's concern is that by buying all this stuff, the Fed might be propping up government debt and artificially pumping up certain markets like housing.
So their actions are having all these ripple effects that we might not even realize. And what's great about this chapter is it doesn't just stop at complaining. It actually lays out some really bold suggestions for how to fix these problems.
Yeah, it's impressive. They're very systematic. For every problem they identify, there's a specific solution.
Okay, so let's talk solutions. One of the biggest ones is getting rid of that dual mandate we talked about. They say the Fed should just focus on keeping the dollar stable.
And to further reduce their power, the chapter suggests shrinking that massive balance sheet, only buying U.S. treasuries, and stopping paying interest on something called excess reserves, which is basically extra money that banks hold at the Fed.
So it's like they're saying, let's simplify things and limit the Fed's influence. That's pretty radical.
It is. But it doesn't stop there. They also propose putting the Fed on a sort of autopilot. by using something called monetary rules.
Monetary rules. What's that all about?
So imagine setting up a set of traffic laws for the monetary system. Instead of the Fed making decisions based on their judgment, they have to follow these predetermined rules.
Oh, interesting.
This could help limit their power and make things more predictable.
So less winging it and more by the book. What kind of rules are they talking about?
Well, they give us three main options: free banking, commodity-backed money, and the K% rule. Each has its own pros and cons, but basically they represent different points on a spectrum of how much control the government has over money.
Okay, break those down for me and for our listeners.
Okay, so free banking is the most radical. It basically says, let the banks do whatever they want. The government shouldn't interfere at all.
Okay.
Then you have commodity-backed money, which is like the gold standard, where the value of the dollar is tied to something physical like gold.
And then the key percent rule. That one sounds a bit more rule-based.
Right, it is. The idea is that the money supply can only grow by a fixed percentage each year, like 3%. This would limit the Fed's ability to manipulate the economy by printing money whenever they feel like it.
So it's like putting a speed limit on money creation. That makes sense. But the chapter also acknowledges that these are some pretty major changes.
Oh yeah, they do. And that's why they also present a set of what they call minimum effective reforms. These are smaller, more practical tweaks that could still make a big difference without requiring a complete overhaul of the system.
So like baby steps towards a better system.
Exactly. These minimum reforms include things like removing that full employment goal from the Fed's plate so they can focus solely on price stability.
Okay.
They also suggest that the Fed should have clear targets for inflation and that regulations should focus on making sure that banks have enough capital to weather any storms.
So it's all about creating a system that's less prone to those wild swings we've seen in the past. A system that's more stable, predictable, and ultimately more accountable.
Precisely.
Yeah.
And to get the ball rolling, they even call for a special commission to be formed. Their mission would be to reevaluate the entire purpose of the Federal Reserve and to explore potential alternatives.
Wow. So a national conversation about money.
Basically, yeah.
It's incredible how much ground this chapter covers. It really takes us on a journey from the history of the Fed to its current problems and this whole menu of potential solutions.
We've only just begun to unpack all the complexities, but one thing's for sure, the Federal Reserve and the decisions they make have a massive impact on all of our lives.
Yeah, it's easy to think of them as this like faceless institution, but their actions have real-world consequences for everyone. It's like the chapter is saying, hey, let's not just complain about the Fed, let's understand it and let's work towards making it better.
And that's what makes this deep dive so fascinating. It's not just about understanding the past. It's about thinking critically about how we can shape a better financial future for ourselves and for generations to come. And they don't just, throw these reforms out there. They actually go into the pros and cons of each approach. Like, they point out that moving to a free banking system, while it sounds good in theory, could be really disruptive in practice.
Yeah, like ripping off a Band-Aid. It might be better in the long run, but it's going to sting.
Right, exactly.
Yeah.
The authors acknowledge that implementing any of these changes would have to be done very carefully and gradually. You don't want to throw the whole system into chaos. There's no quick fix here.
No magic bullet.
Oh.
But it's not just about these big picture reforms. The chapter also gets into some very specific issues, like the Fed's influence on the housing market.
Oh, yeah, that's a great example. They call out the Fed's purchases of those mortgage-backed securities, those bundles of home loans. They argue that these purchases have actually contributed to those sky-high house prices we've been seeing.
Oh, so it's like the Fed is out there bidding against regular home buyers, but they have like an endless supply of cash. No wonder prices are going crazy.
Right. It's like you're manipulating the market. By pumping so much money into the mortgage market, the Fed is artificially boosting demand and driving up prices, making it harder for people to actually afford homes.
And they back this up with some pretty hard-hitting data.
Oh, absolutely. They point to things like the dramatic rise in home prices, the growing gap between home prices and incomes, and the increasing burden of mortgage payments on families.
Yeah.
It's hard to argue with those numbers.
So what's the solution?
Well, the chapter suggests that the Fed needs to step back from the mortgage market, either by selling off the assets they already own or by just letting them expire without buying new ones.
Okay, so it's a pretty big step back.
It is. It's a bold move considering how much they've invested in these mortgage-backed securities. But the authors believe it's a necessary step. to curb this artificial inflation and let the housing market find a more natural equilibrium.
So it's like they're saying, hey, Fed, hands off the housing market. Let supply and demand do their thing. But it's not just about housing. They also get into this whole controversial topic of a central bank digital currency, or CBDC.
Oh, yeah. CBDCs are definitely a hot topic these days. So it would basically be like a digital version of the US dollar, but issued and controlled by the Federal Reserve.
Okay, so instead of carrying cash, we'd all be using digital wallets controlled by the Fed. Sounds futuristic, but also kind of scary.
Yeah, there are some definite pros and cons.
Yeah.
The chapter raises some serious red flags about privacy and government overreach.
Yeah, because with a CBDC, the government could potentially track every single transaction you make.
Exactly.
It raises all these questions about surveillance and control.
It could give them a level of power we've never seen before.
It's like that Black Mirror episode where they track your every move and assign you a social score based on your behavior.
Yeah.
Not exactly the future I want to live in.
Right. And the chapter argues that a CBDC wouldn't even offer any significant benefits
Yeah.
that we don't already have with our existing systems, like electronic payments and online banking.
Right. So it's like, why take on all that risk to our privacy and freedom if there's no real upside?
The chapter seems pretty clear that a CBDC is a bad idea.
Yeah, they definitely take a strong stance against it. It's an important reminder that we need to be careful about handing over more power to central banks, especially when it comes to something as fundamental as our money.
Absolutely. It's all about finding that balance between embracing innovation and protecting individual freedoms.
This chapter does a great job of laying out those potential dangers.
It's a cautionary tale for sure, encouraging us to think critically about the implications of these radical changes to our monetary system. We can't just blindly accept new technology without considering the potential downsides.
It's like the chapter saying, hey, wake up, people. This is your money we're talking about.
Exactly. It's a call to action, to engage in these important conversations, weigh the evidence, and form our own informed opinions.
It's not about blindly accepting what the authors say, but using their insights as a starting point to better understand this complex issue. And speaking of complex, we've covered a lot of ground today.
We have.
We've explored the Fed's history, the problems it's facing, and a whole range of potential solutions, from like radical overhauls to more incremental reforms.
And it's clear that reforming the Fed is no easy task. There are so many moving parts, so many different perspectives, and no single answer that's going to satisfy everyone.
Yeah, it really feels like this whole chapter is like a call to action, like urging us to get involved and actually try to shape the future of our monetary system.
It definitely is. And remember, even if those big sweeping reforms seem really daunting, the chapter lays out those minimum effective reforms as a starting point.
Right, those are like the low-hanging fruit.
Exactly.
Like changes we can make that could actually make a difference without having to like reinvent the wheel.
Yes, small tweets with big ripple effects. Exactly.
You know, it's easy to get overwhelmed with all this talk about monetary policy and financial systems and all this stuff. But I think this deep dive has really driven home the point that the Fed's decisions impact all of us, whether we realize it or not.
Oh, absolutely. It's not some distant abstract entity. It plays a huge role in shaping our lives.
Yeah, and this chapter really empowers us to like see that and to understand the levers that can be pulled to create a system that works better for everyone.
For sure.
It's like the author saying, look, you don't need a PhD in economics to understand this stuff. It's your money, your future. Get involved.
Couldn't have said it better myself. This deep dive has been awesome. We went through the history, the challenges, the potential solutions, all surrounding the Fed.
Yeah, we learned about the unintended consequences of good intentions, the dangers of unchecked power, and the possibility of actually creating a more stable and accountable financial system.
And most importantly, we've been reminded that we all have a role to play in shaping that future. We can educate ourselves, engage in these conversations, and hold our leaders accountable for creating a monetary system that truly serves the people.
This deep dive has really just scratched the surface, but hopefully it's made you a little bit more curious and given you some tools to continue exploring these issues.
So keep learning, keep questioning, and keep pushing for a better financial future. Thanks for joining us on this deep dive into the world of the Federal Reserve.